trade that damages you most is often the one you were right about. You saw the direction clearly. You read the tape well enough. The market moved as expected. And still, when it was over, your account was smaller, your judgment was shaken, and your next decision carried a weight it did not have before. That is the quiet danger of position sizing. It can turn a good opinion into a bad outcome. A trader usually does not discover this problem when he is ignorant. He discovers it when he becomes confident. He begins to think the quality of the idea deserves a larger commitment. He tells himself that conviction should be expressed in size. But the market does not reward conviction by itself. It rewards judgment under pressure. And pressure is not created by price movement alone. It is created by the amount you have at risk while price is moving. This is why position sizing is not merely a money management detail. It is a psychological instrument. It determines how clearly you can see after the trade begins. A position that is too large does not just threaten capital, it changes the trader observing the market. He stops reading price and starts defending himself. He sees ordinary pullbacks as personal attacks. He mistakes hesitation for betrayal. He takes profit too early because relief has become more important than accuracy. Or worse, he refuses to cut the loss because admitting error has become too expensive. Notice this carefully in your own trading. When the size is reasonable, you can watch the market with some detachment. You can see whether volume confirms the move, whether price accepts a level, whether the reaction is normal or abnormal. But when the size is too heavy, every tick carries a verdict. You no longer study the trade, you endure it. And a trader who is enduring the market is rarely in command of himself. The hidden cost is not only the loss on that one position. The greater cost is what the oversized trade does to the next 5 decisions. A large loss makes a trader timid when he should be active. A large win can be just as dangerous because it teaches him to confuse exposure with skill. Either result bends his behavior. He increases size when he should be selective. He reduces size when the opportunity is clean. He begins reacting to the emotional memory of the last trade instead of the present structure of the market. So before asking how much you can make, you must ask what size allows you to remain useful to yourself. What size permits you to be wrong without becoming reckless? What size allows you to be right without becoming careless? This is where serious trading begins, not with a prediction, but with a limit placed on your own capacity for disorder. The market will always offer reasons to do more. A sharp breakout, a perfect setup, a news catalyst, a pattern that looks cleaner than usual, but the trader must learn to distinguish opportunity from invitation. The market may invite you to overcommit. It will not protect you from the consequences. You can learn a great deal about a trader by watching what happens to him after he increases his size. At small size, he may seem patient, reasonable and clear. He can wait for the setup. He can accept a loss without argument. He can watch price move against him and still think plainly. But double or triple the size, and a different man may appear. Not because the market has changed. Not because the method has changed. Because the amount at risk has changed the pressure inside the trader. This is one of the first truths a serious trader must face. Position size does not only affect the account. It affects the mind that must operate the account. A trade can be technically sound and still be too large for the person taking it. That is where many traders misjudge themselves. They think the question is, can this trade work? But a better question is, can I remain steady while this trade is still undecided? The market does not test you after the result is known. It tests you while the outcome is unclear, while price is moving back and forth, while your opinion is being challenged, but not yet proven wrong. That uncertain space is where size reveals itself. When the position is too large, ordinary market movement begins to feel meaningful. A small pullback feels like a warning. A pause feels like danger. A tick against you feels heavier than it should. The trader begins assigning emotional weight to movements that may have no real importance. The market is doing what markets do, but the trader is no longer seeing it cleanly. His size has made the picture appear larger, closer, and more threatening. This is why fear is not always a weakness in character. Sometimes fear is information. It may be telling you that the trade is bigger than your ability to observe it calmly. A man who cannot look at his open position without tightening his body, refreshing the screen, and calculating the damage every few seconds is not trading the market anymore. He is measuring his discomfort. And once discomfort becomes the center of attention, judgment begins to narrow. The trader no longer asks, "What is price telling me?" He asks, "How much more can I stand?" That is a dangerous change. It moves the mind from analysis to survival. In survival, patience becomes difficult. Objectivity becomes expensive. Every movement seems personal because too much of the trader's emotional balance has been placed inside one position. This is the hidden function of position sizing. It sets the emotional temperature of the trade before the trade begins. You may think you are choosing risk, but you are also choosing the state of mind from which you will interpret every candle, every pause, every rejection, every move against you. If the size is wrong, your interpretation will be wrong more often, because pressure will speak louder than evidence. You must learn to notice this without pride and without self-deception. Do not ask whether you wish you were calm. Ask whether you actually are calm. Can you let the trade breathe without needing constant reassurance? Can you watch a normal adverse move without turning it into a crisis? Can you accept that the market may take time to prove or disprove the idea? The proper size is not the size that excites you. It is not the size that proves courage. It is the size that allows you to stay mentally available. Available to see. Available to listen. Available to admit that the trade is not doing what it should. Available to let the market speak before your fear interrupts it. A trader should study his own reactions as carefully as he studies price. If one size lets you think clearly and another size makes you anxious, the market has given you useful knowledge. The answer is not to pretend you are stronger. The answer is to respect the condition under which your judgment remains reliable. A trade is not truly under control because you planned it. It is under control only when you can carry out the plan while price is moving. This is where position size proves itself in the open market. Before entry, everything can look orderly. The level is marked. The stop is known. The target is reasonable. The setup has appeared before. But once the order is live, the trader must act, not imagine. He must enter without chasing, exit without bargaining, and accept the signal without delay. If the size is too large, the first thing to suffer is not theory. It is execution. You will see it in small failures before you see it in large losses. The trader waits for a clean entry, but the moment arrives and he hesitates. Price moves without him, so he enters late. Now his risk is no longer the risk he planned. Or he sees the stop approaching and, instead of honoring it, he gives the trade little more room. But that room was not part of the trade. It was created by discomfort at the moment of decision. Or the trade moves in his favor, and he exits too soon, not because the move is finished, but because the profit is large enough to make his hand unsteady. These are not random mistakes. They are execution errors caused by size. A properly sized trade allows action to remain simple. The entry trigger appears, you take it. The stop is reached, you leave. The trade behaves well, you stay with the conditions you agreed to. This does not mean the trade will win. It means the trader can perform his duty without negotiating with every tick. When size is wrong, each instruction becomes harder to obey. The plan remains on paper, but the hand begins to improvise. That is a serious matter, because the market does not pay a trader for having a plan he cannot execute. A poor entry changes the whole character of the trade. A late exit changes a manageable loss into a larger one. An early exit from a sound move teaches the trader to distrust his own process. One broken action leads to another, because once the trader has violated the plan, he is no longer following a system. He is managing the consequences of disobedience. This is why you must judge your size by your conduct, not by your confidence before the trade. Do not ask only, was I willing to risk this amount? Ask, did this amount let me act correctly? Did you enter where the trade was meant to begin, or did you chase after needing confirmation? Did you exit where the trade was meant to end, or did you pause and hope? Did you reduce the trade because the market told you to, or because you wanted relief? The answer is found in your actions, not in your intentions. There is a quiet discipline in making the trade small enough to execute cleanly. Some traders see this as weakness. It is not weakness. It is respect for the fact that execution is the narrow bridge between analysis and results. A trader can read the market well and still fail if his size causes him to act poorly at the exact moment action is required. The market often gives only a short window for proper execution. A level breaks, a rejection appears, momentum fades, liquidity disappears. The trader who is oversized tends to pause at the wrong moment and rush at the wrong moment. He delays when precision is needed, then acts impulsively when patience would have served him better. Size has disturbed the timing of his hands, so study the evidence. Look at your trades where the idea was sound but the handling was poor. Look for late entries, moved stops, cancelled exits, rushed profits, and added risk that was never intended. These are not merely bad habits. They are messages. They may be telling you that the size you chose was larger than the size you could execute with discipline. The right position size is the one that keeps your actions clean. Not perfect, clean. You will still take losses. You will still misread trades. But you must not let size turn every decision point into a contest between your plan and your impulses. A trader can be completely convinced and still be risking too much. This is difficult to accept because conviction feels like evidence. When the setup is clean, when the chart agrees with your view, when the trade seems obvious, it is natural to think the size should rise with the strength of the opinion. But the account does not measure the purity of your belief. It measures the amount lost when the trade fails. That is why position sizing must begin with arithmetic, not feeling. The market may give you a strong idea, but only mathematics can tell you whether the idea is survivable. A trader who risks too much on one position has allowed a single outcome to carry more importance than it deserves. The trade may have quality. It may even have a favorable probability, but no probability is certainty. Once you understand that, you stop asking, "How sure am I?" and begin asking, "What happens if I am wrong?" This question brings discipline into the trade before damage is possible. Every position has three numbers that matter before entry: the account size, the distance to the point of invalidation, and the amount you are willing to lose if that point is reached. Without these numbers, size is only a guess dressed up as confidence. If the stop is wide and the position is large, the risk may be excessive even though the chart looks calm. If the stop is tight and the position is large, the trade may still be fragile because a small normal move can produce a full loss. The number of shares, lots or contracts means very little until it is tied to the actual money at risk. This is where many traders deceive themselves. They say they are taking a small position because the number of units looks small, or they say they are being aggressive because the setup is strong. But size is not defined by appearance. It is defined by consequence. A small-looking position with a distant stop may carry greater risk than a larger-looking position with a defined, closer invalidation point. The account does not care how the trade looks. It only records the loss. For this reason, the first rule is to decide the loss before deciding the size. If you know the exact amount you are prepared to lose, the rest becomes calculation. The distance from entry to invalidation tells you how large the position can be. If the distance is wide, the size must come down. If the distance is narrow, the size may come up, but only within the same risk limit. This keeps the trade from becoming an opinion contest. You are not increasing size because you feel certain. You are sizing so that uncertainty has a fixed cost. That fixed cost is what protects the trader from ruin by ordinary error. Every method will have losses. Every good trader will be wrong. The purpose of sizing mathematics is not to avoid being wrong. It is to make being wrong affordable. When a loss is affordable, it remains one event. When a loss is too large, it becomes a turning point. It forces recovery thinking, reduces flexibility, and changes the condition of the account. A trader must also respect the difference between percentage risk and dollar discomfort. A 1% loss may sound small when spoken in theory, but as the account grows, that 1% becomes a larger dollar amount. The formula may remain the same, while the trader's ability to accept the number may not. So the calculation must be honest. It must protect the account, but it must also be something the trader can actually obey when the loss appears on the screen. Do not let a beautiful setup talk you out of the math. Do not let a winning streak convince you that the next trade deserves exception. The moment you allow belief to replace calculation, you have given the market permission to decide how much you lose. And the market is never careful with a trader who arrives without a number. The serious trader reverses the order. First, define the loss, then measure the distance, then calculate the size. Only after that does the trade deserve consideration. The same position can be conservative in one market and dangerous in another. A trader may think he is being consistent because he uses the same number of shares, the same lot size, or the same contract size from trade to trade, but the market is not consistent in that way. One day it moves quietly from level to level. Another day it snaps, widens, gaps, and rejects prices with force. If your size remains unchanged while the market's behavior changes, your real risk has changed without your permission. This is why position sizing cannot be separated from market structure. A trade does not exist in empty space. It exists inside volatility, liquidity, range, trend, spread, speed, and the distance between meaningful levels. A position taken inside a tight, orderly range is not the same as a position taken during a wide expansion. A trade entered near clear structure is not the same as one entered in the middle of disorder. A liquid market that absorbs orders smoothly is not the same as a thin market where price jumps because there is little standing in its way. The market tells you how much room a trade requires. If the normal movement of the instrument is wide, then a small stop may be meaningless. It may not mark invalidation. It may only mark noise. And if the trade requires wider room to be judged fairly, then the size must come down. Otherwise, the trader is not taking a structured risk. He is placing a large position inside a market that naturally swings beyond his tolerance. This is a common source of confusion. The trader believes the trade failed because the stop was hit. But often the trade was never given room to prove itself. The stop was placed where the account wanted it, not where the market made sense. The position was too large for the actual structure, so the trader was forced to use a stop that belonged to his comfort, not to the chart. That is not discipline. It is poor alignment. A market with wide structure demands respect. The distance between support and resistance may be greater. Pullbacks may travel farther before the trend remains intact. Breakouts may retest deeper before continuing. In such conditions, the trader who refuses to reduce size will be pushed into bad placement. He will enter with too much exposure, use too little room, and then blame the market for moving normally. Liquidity deserves the same attention. In a thick market, orders may be filled close to expectation. In a thin market, the price you see and the price you receive may not be the same. A stop can slip. An exit can widen. A sudden order can move price sharply because there are not enough participants on the other side. Size that looks acceptable on the screen may become excessive when the market cannot absorb it cleanly. Volatility is not an enemy, but it must be paid for with smaller size. If the market is moving in larger increments, then each unit carries more consequence. The trader who keeps the same size during expansion is not trading the same risk. He is increasing exposure simply by refusing to adjust. The danger is quiet because nothing appears to have changed in his order ticket. But everything has changed in the market beneath it. So before deciding how large the trade should be, study the character of the instrument that day. How far does price normally travel before turning? Are pullbacks shallow or violent? Are levels being respected cleanly, or are they being pierced and reclaimed? Is volume supporting movement, or is price jumping through thin areas? Is the spread tight, or is the market warning you that execution will cost more than usual? These observations are not decorative. They determine whether your intended size fits the environment. A narrow, liquid, orderly market may allow closer definition. A wide, fast, unstable market demands less size because the trade needs more breathing room. The rule is simple, but it is often ignored. When the market needs more room, the trader must bring less weight. Position size should bend to the market's present condition, not to what the instrument usually does, not to what it did last week, not to what you prefer it to do. The present structure is the authority. When you respect it, your risk is built around the market as it is. When you ignore it, you force the market into your desired shape, and the market has no obligation to fit. The worst position size is often chosen after the market has already stirred your desire. You see price moving without you. You see a clean candle, a fast breakout, a sudden rejection, or a trade that seems to be leaving the station. In that moment, the mind does not calculate with the same honesty. It begins to lean forward. It wants participation. It wants to avoid regret. And when desire enters before size is decided, the trader is no longer measuring risk with a calm hand. This is why the timing of the sizing decision matters. Position size should be chosen before the trade becomes emotionally attractive, before the entry trigger flashes, before the move begins to look urgent, before the trader starts imagining the profit he might miss. A calm decision made too early is usually better than a passionate decision made at the edge of action. When the market is still quiet, you can think in terms of risk, conditions, and limits. When the market is moving, you are more likely to think in terms of opportunity, speed, and escape. That change is subtle, but it is costly. The trader who waits until the last moment to decide size invites the market to influence his discipline. A strong move may persuade him to take more than he intended. A recent loss may whisper that this trade can repair the damage. A recent win may make him feel entitled to press harder. None of these are proper reasons. They do not come from the trade plan. They come from the trader's condition at the moment of decision. A sound sizing decision must be made while you are still capable of refusing the trade. That is the test. Can you decide the size before you feel pulled toward the entry? Can you define what is acceptable before the market begins to tempt you? If the decision is made only after you want the trade, then the decision is already under pressure. You may still call it discipline, but part of you is negotiating for permission. The market is very skilled at creating urgency. It shows you motion. It makes patience feel like hesitation. It makes restraint feel like lost money. But urgency is not evidence. A trade that cannot be sized calmly is already asking too much from the trader. The market may continue without you, and that is no tragedy. The greater mistake is to let movement force a decision that should have been settled before the movement began. You must learn to separate preparation from reaction. Preparation says, if this condition appears, this is the size I am willing to take. Reaction says, now that this is moving, how much can I get into it? The first keeps authority with the trader. The second hands authority to the moment. This difference becomes especially important around strong setups. The cleaner the trade appears, the easier it is to excuse poor timing in the sizing decision. The trader tells himself the opportunity deserves it, but an attractive trade does not cancel the need for prior judgment. In fact, the better the opportunity appears, the more important it is to have already decided what you are allowed to do. Desire is strongest when the chart looks obvious. So make your sizing decision before the trade has a chance to persuade you. Decide under quiet conditions what your normal size will be for that setup, what will make you reduce it, and what will make you pass entirely. Do this before the candle is forming, before the alert sounds, before the market begins to move fast enough to disturb your judgment. This is not caution for its own sake. It is a way of keeping your decision clean. A trader who decides size in advance can enter the moment with less argument inside him. He may still be wrong. He may still miss trades, but he is not inventing risk while the market is applying pressure. A professional trader does not approach every new trade as if he is inventing his risk for the first time. He may study each market on its own terms. He may wait for different conditions, different patterns, and different levels. But the way he handles risk has structure before the opportunity appears. He is not standing in front of the market asking, "How much do I feel like trading today?" He already knows the boundaries of his operation. That is one of the quiet differences between a trader who survives serious markets and one who is always being pulled around by them. Position sizing becomes dangerous when it is treated as a fresh opinion on every trade. Without a standard, Every setup can argue for special treatment. One trade looks cleaner, another feels urgent, another comes after a missed move, another appears during a strong session. If the trader has no established sizing habits, the market will keep presenting reasons to adjust. Some of those reasons will sound intelligent, but without a firm operating method, adjustment becomes improvisation, and improvisation eventually becomes inconsistency. This is why professionals standardize risk before they chase opportunity. Standardizing risk does not mean trading the same size in every condition. It means knowing in advance what your ordinary risk looks like, what reduced risk looks like, and what conditions require no risk at all. A normal trade should have a normal size. A lower, quality trade should have a smaller size or be passed. A trade outside your best conditions should not be rescued by enthusiasm. The habit is not rigidity. The habit is classification. This classification removes a great deal of unnecessary argument. When a setup appears, the serious trader does not ask from nothing. He asks, what category does this belong to? Is it a primary setup, a secondary setup, or a marginal situation? Does it fit the conditions he has chosen to trade, or is he stretching the definition? Once the category is known, the size is largely known. This keeps the trader from using imagination where procedure should stand. The benefit is not only cleaner risk, it is cleaner thinking. When position size has no standard, the trader spends mental energy debating the wrong question at the wrong time. He studies the chart, then studies his desire, then studies his fear, then studies the money. The trade becomes crowded with competing voices. But when risk tiers are defined beforehand, much of that noise is removed. The trader can concentrate on whether the setup is valid, not on how much emotion he can justify attaching to it. A professional also respects maximum exposure. He knows that a single trade is not the only source of risk. Several related positions can behave like one large position. Trades in the same sector, the same currency, the same market theme, or the same direction may all depend on the same underlying force. If he sizes each one as though it stands alone, he may think he is diversified while he is actually concentrated. The habit here is simple count risk by what can move together, not merely by how many tickets are open. That kind of thinking must be reviewed regularly. A trader should know whether he is following his own sizing standards, not vaguely. Specifically, did he use normal size only on normal conditions? Did he reduce size when the situation was less clear? Did he avoid stacking similar exposure without realizing it? Did he increase size because the trade met a defined standard, or because he wanted the trade to matter more? These questions turn position sizing from a private impulse into an observable practice. This is how professionalism is built, not through one grand act of discipline, but through repeated decisions that leave a record. The market will always be uncertain. That cannot be standardized. But your treatment of risk can be. Your tiers can be known. Your limits can be known. Your exposure rules can be known. Your review can be honest. Then, when opportunity appears, you are not asking the market to help you decide who you are. You arrive with a method already in place. The trade is not finished when you enter. In many ways, that is when the real work begins. Before the order is filled, the trade belongs to planning. After the order is filled, it belongs to management. Price may move cleanly, or it may hesitate. It may advance, pull back, test your entry, fail, recover, or offer profit before the larger move has developed. The question is not only whether your idea was good. The question is whether your position size gives you room to manage the idea as it unfolds. A trade that is too large becomes rigid. It gives the trader very few choices after entry. He cannot hold through ordinary reaction. He cannot scale out without feeling that the remaining position is still too heavy. He cannot add only if the trade improves, because he has already spent too much risk at the beginning. He cannot wait for confirmation after the first move, because the position is already demanding a result. Oversize makes the trade brittle. Every decision becomes either escape or endurance. Proper size creates flexibility. When the first position is measured correctly, you are not forced to solve everything at once. You can let the market confirm or deny the idea in stages. You can take partial profit if price gives a quick move but leaves the larger structure intact. You can hold a remainder while the trade still has room to develop. You can tighten risk when the market earns it, not simply because you are eager to feel safe. The position is not controlling you. You are still able to manage it. This matters because markets rarely move in the clean line imagined before entry. A sound trade may begin slowly. It may test the level twice. It may offer a small gain, then return near entry before continuing. It may show strength, then require patience while new buyers or sellers prove themselves. If your size is too heavy, these normal developments become difficult to handle. You may close a trade that has not failed. You may refuse to adjust a trade that has clearly weakened. You may take action because the position is uncomfortable, not because the market has changed. Trade management requires enough space between the trader and the position. That space is not carelessness. It is working room. A carpenter cannot work with his tools pressed against his chest. A trader cannot manage well when the position leaves no margin for thought. If every movement demands an immediate reaction, the size is too large for management.